Apple's earnings weighing on the NASDAQ this morning, the NASDAQ moving lower, but we're also seeing lower bond yields. How does that shape your thoughts of the market? Obviously, Apple's also a very influential stock.
Yeah, so we think that, Apple is now in the mature stage of its business. So obviously it is going to, you can't expect the same level of growth that you were expecting before. But bottom line numbers, they still beat expectations. We think that as far as the market is concerned, last time we were on the show, we called for a pullback and that played out. And whatever fundamentals, whether it's GDP, whether it's unemployment, is still relatively strong. So we feel that we are positioning here for a year-end rally in the equity markets.
Talk to me about this year-end rally. We had some guests on yesterday talking about a Santa Claus rally possibly. What's going to fuel this year-end rally? Because at the same time, we're still seeing attractive yields on bonds. They're lower, about 20 basis points lower after the hawkish pause, but still very attractive. In fact, one analyst, Vanda Research, put out a note called T-bill and chill, just saying you should park your money there. It's a safe bet.
Absolutely. So when the 10-year T-bill is at a 16-year high, the risk-free trade is very attractive. So every time there's any negative news, we'll see a flight to safety, and that will create volatility in the market. Also, with the geopolitical tensions, I think that's going to create further volatility. But we feel that with volatility, there's opportunity. And we will be focused on taking advantage of those opportunities for our clients.
So speaking of opportunities, you gave us a few picks that you're looking at right now. So one of them is Google, following earnings, down pretty big earnings on October the 24th. The other one's Tesla, following earnings on October the 18th. Both down significantly. Why is now the time to seek an opportunity and buy the dip on these stocks?
Well, investors have been pining to buy the Magnificent Seven at good prices, and some of the earnings reports are giving us the opportunity to do so. So a stock on our watch list, Tesla, for example, they're disappointed on earnings because obviously when rates are up, the consumer is going to get affected on buying an expensive vehicle. But at the end of the day, there's a broader trend over here. By 2035, according to some estimates, electrical vehicles on the road are expected to increase by 500%, and Tesla is the biggest beneficiary of that.
All right, what about Alphabet? What makes this an attractive entry point right now?
Well, another stock on our watch list that we are really fond of, so when they came out with their numbers, we thought it was good. Revenues went up by 11%. Street didn't like it because there was disappointment on the cloud. We think that the strength in the advertising business is far more important, far more significant than the weakness in the cloud business, because that's a more significant portion of the company's revenue. So for that reason, we remain constructive on this pullback.
All right, I want to come full circle. Again, you're calling for a year-end rally. Where does this rally start? Does it start after the next Fed meeting? What's the catalyst for it?
I think the catalyst for it is that, the earnings are coming out relatively decently. Valuations look good. Fundamentals are strong. If you look at the September retail sales data, it crushed expectations. So for that reason, we think that from here till the end of the year, the market should be positive.